Hi, this is Pat with Energy Solution Partners sharing with you our energy market view on Saturday, May 3rd. Always keep in mind there is a risk of loss when trading commodity futures and options. We put these market views together to share with our clients, just to share what we're looking at in the current marketplace and items that are out there, I guess, that we feel are worthy of noting as you look at your own positions and look at any price risks that you may have to mitigate. So we always welcome any feedback from you on this commentary. Let us know if this is valuable or if there's any other items that you'd like to see or hear in these comments, and that feedback is always welcome. We're going to spend today's market view talking macro view of the energy picture here, and maybe some things that are transpiring here in a bigger view, mostly tied to crude oil. So as crude oil trades, so will go the products, whether it's gas, diesel, propane. But crude is going to be the driver here, and that's what we're going to focus on today. First of all, we'll look at these inventory levels in Cushing, Oklahoma, and this is the delivery point for the WTI contract. And so a very important hub, although the total inventory in this hub is relatively small, but because it does price WTI in a world market, it is a very important hub. As we look at these inventory levels, first of all, this green line up above, that's last year's inventory levels in 2013. And you can see it stayed pretty steady in that 50 million barrel range and through the first half of the year. And it did start to draw down a little bit in the second half of 2013 as some of these pipeline reversals were taking place, trying to get this crude oil moved out of the mid-continent down into the Gulf Coast refining sector. And it's been somewhat successful. And the latest pipeline reversal came on, I believe it was late December timeframe. And if we look at this red line here, which is this year, you can see how this has finally affected these inventories in Cushing. And since the first of the year, we have drawn these Cushing inventory levels down by 16 million barrels. So a pretty steady drawdown there. And looking where we're at today, near 25 million barrels compared to a year ago, we have cut that Cushing inventory in half. As we look at what crude prices have done, you can see since the first of the year, this market has ran higher here, and I think it is in relation to the drawdown in the Cushing inventories. So the market has been pretty much totally fixed on what has been going on in Cushing, and I think maybe ignoring some of the other areas out there and some of the other things going on in this crude market. But also of interesting to note in this chart, kind of a technical view, we have ran up to this $105 on two different occasions and pulled back. So that does indicate a double top from a technical standpoint, and worthy noting, I guess, as we move forward. But again, kind of amazing to watch this crude market rally here since the first of the year, when overall inventories we've actually climbed, but this market does seem to be focusing on that drawdown in the mid-continent. The other area I like to focus on is the speculative money that flows in and out of these commodity markets. And this little snapshot is a picture of the managed money in the crude oil futures contract, and the managed money would also be known as the speculators. But this red line shows the money flows that have come in here in 2014, and this is a net number of total long positions, and today we sit at 320,000 long contracts, and each contract represents 1,000 barrels of crude. So this would suggest that the speculative money has a long position in 320 million barrels of crude oil. That would represent about 18 days worth of our demand here in the U.S. So very long position in crude oil here. And as this money flows in, at some point it generally comes back out. And so the more that does flow in, I guess I get a little more concerned of a possible bubble that's being created. If we look back here, this blue line shows 2011, so you can see how that speculative money came out of the market in 2011 and what happened price-wise during that time frame. We watched crude oil go from $115 a barrel down to $75 a barrel. So as that money came out, the price dropped with it. And And that price drop wasn't solely due to this money coming out. I believe that was in the middle of the European financial crisis there, so they kind of go hand in hand. But if we look again at 2012, the drop that took place here with the money flowing out of the market, and we watched prices that year go from $105 a barrel down to $77.50. So again, they kind of go hand in hand. And then lastly, here in 2013, we actually watched money come into the market. And what happened with crude prices last year from this time going forward, we went from $90 a barrel up to $110 as the money has come in. But again, today we're sitting at some pretty high levels of a long position from the speculative community. So a little suspicious when this money starts to come out and what that will do to pricing. If we look at total U.S. inventory data here from the EIA, we're sitting at 400 million barrels of crude, which is record inventory levels. And if we look at this red line, how this inventory is growing just since the first of the year, and you can see we're well above the 5-year average range. So we just totally swelled in crude inventories. But the other item that following here that I think is worthy to note, if we look on the right hand side here, the total amount of crude oil that's going into refineries, and that's running at some very high levels. The refinery inputs on the last weekly report showed 16.3 million barrels per day of crude going into refineries. And while it's not at the highest levels, we are at some very high levels for this time of year. This chart, all these other lines are previous years, so very busy, and that's not important, I guess. But what is important is to show how much more we're refining today than what we typically have been doing for this time of year. So we're using more crude in the refining process compared to this point previous years, but at the same time we continue to grow these inventories. Now, if we look down into the Gulf Coast, where our big refining sector down there, what's taking place in the Gulf Coast, which I think is somewhat fascinating, and the market is kind of ignored this as we focused on the whole Cushing thing. But at the same time Cushing's drawn down, look what's happened here in the Gulf Coast. And especially just since the first of the year here, again, this red line is this year's inventory levels. And we have grown that up. Today we're sitting at 215 million barrels, and that's up from 165 million to start the year. So very impressive inventory builds here, and at record levels here. And while there's no official data that is reported on what the capacity is, it is thought in the marketplace that we're starting to approach the maximum capacity here on these Gulf Coast inventory levels. So I guess what I think may happen here, if we do reach a capacity level, all that inventory that has flowed from Cushing down into this Gulf Coast area, it's going to start to back up into Cushing again. So we'll want to keep our eye out for that. And if we do see this start to back up into Cushing and those Cushing inventories start to increase again, probably going to put a little downward pressure on those prices. And keep in mind, as those inventories in the mid-continent have drawn down, prices have gone up. If we reverse that drawdown, looking at these record levels of inventory, I guess we have to be thinking downside prices on this crude. And also, as we've watched these inventory levels swell in the Gulf Coast, again, this red line would be this year's refinery inputs. Refineries are running at some pretty impressive levels in the Gulf Coast. They're refining 8.5 million barrels of crude oil a day. That's nearly 93% of their capacity, which refineries typically don't run much higher than those levels. I think the record utilization rate we've seen in the Gulf Coast was near 96%. So the Gulf Coast refineries are running pretty much all out, and at the same time, they're just growing those inventory levels. So we are still importing some crude oil into the Gulf Coast, but again, as these levels do continue to grow on an inventory basis, I would look for those imports to go down, and then that crude oil that's not being imported into the U.S. backs up into the world market, and again, I think has to start putting some downside pressure into that world market. So where do we go on prices? I guess you can probably tell from my tone that I'm pretty bearish on the crude oil prices overall, looking at these huge inventories that need to be addressed. But this has been setting up over a long-term period, and I don't think we're going to see knee-jerk reactions or huge price movements here short-term. And I think this whole story needs to play out yet, and we'll continue to watch this on a week-to-week basis. But if we do look at a crude oil monthly chart, and again, a monthly chart gives us a longer range view of what's going on. We have been in a range-bound trade going back to 2011. We started that range at some pretty wide levels, and we've just continued to watch this range narrow here and created this pennant formation. And so what I'm going to be focused on is the trade that's taken place between these trend lines that I've drawn in this pennant formation that's created. And once we break out of this current range that we're in, I think that sets up where we're going. So that you can tell from my bearish tone, I'm probably expecting to come out to the bottom side here, but I got to wait and see that happen to confirm it. And currently today, this bottom end of this line is at $93 a barrel, so we are currently trading about $7 above that yet. If we do trade down that $7 breakout, I think that opens the door for more downside. But we still have to pay attention to the upside as well, and to this upside, if we break out, then I guess it would open the door to go higher here. I'm not sure what the catalyst for that would be, some world events or something, but it's definitely possible here, and we have to know the risk. But the upper end of this range is at $105 a barrel. If we look at the stochastics down below here, again, this measures sentiment, market sentiment, whether it's overbought or oversold. And we're completely neutral right now. So the whole market sentiment is neutral. It is not showing us in an overbought or oversold position. As we look at this big picture setup here, if you have some long exposure, I do like hedging that up, especially out into next fall. And options are actually very cheap. If we're to look at some option plays in that crude oil market, because of the sideways trade we've been in, that has taken the volatility out of the price factor here. And as that volatility comes out, it does make options cheaper. So if you do have some long exposure, I do like the idea of putting some downside protection in place with options, probably in the crude oil market. And this can be used for any of your gas or diesel positions, or even propane. If this crude price does tumble down, it's going to bring those products down with, including propane. I haven't talked a lot about propane, but very low inventory levels there. But we still have to look at this crude market, and it's the 800-pound gorilla that's staring us in the face here. So with that, I'd love to go over these strategies with you. If you have any questions, give us a call, and we can sure take a look. Thanks for listening.